I wish this was around a long time ago. I think it's an amazing opportunity for traders of all levels. And yes, my name is Kai Whitney, and I'm part of a global trading group. And we trade the markets, futures markets, Forex, and we trade them from the early mornings from 8 a.m. till about 3, 4 p.m. And then we also do an Asian session. So we, the Australasian Tokyo. We're thinking about opening up our London session again, but we're basically a group of traders that have come together under the tutelage of a registered CTA, a commodities trading advisor, and his name is Simon Joseph. And it's under his guidance, and what we do is each one of us had, at some point, we were students. We were students of his. And he taught us how to read the market by reading the numbers, the tape, what people call order flow. And it's an opportunity to really get a firm grasp, a firm understanding of how the markets actually operate. So I don't want to talk to you tonight. I don't want to sell you anything tonight. I kind of want to just open this up, if you don't mind, for a little bit of discussion, because I had there was a teach-in that I did this afternoon with our students, and it kind of struck a chord, because I really love it when people come to us and they're just struggling and struggling and struggling, because trust me, we've all been there, and it's really great to see the light come on. And so I want to share with you just a little bit about what we were talking about, and it's really, so I put it together, and the subject was well received, because it does apply to all time frames. It applies to options, it applies to futures, Forex, and stocks. And basically, the topic is all about having an edge, finding that edge, first of all, then having that edge, and then knowing your strengths and your weaknesses, and more importantly, know your competition. You can do this, you can do all of this by learning how to decode order flow volume, which will help identify the market's natural support and resistance levels. And these support and resistance levels are decided by your competition. So who is our competition? Our competition is actually the commercial traders, the institutions, those that trade for the governments and hedge for large companies like ExxonMobil and United Airlines and Monsanto and hedge currencies. And if we didn't have these futures markets, hey Jimmy, if we didn't have these futures markets, we literally would be like Egypt, or we'd be like Venezuela, and we would have these markets that were so erratic. The prices of foods, of survival, would be so high, inflation would be so high, that we'd be going to the streets with pitchforks. And so it's really important to understand who our competition is and what is it that they're actually there to do. And then it's from my bias that this is all what they call market generated information. So for those that maybe aren't familiar with that term, it basically means, just to dumb it all down, it basically means that it's the only order flow, or the numbers, the bid and the ask, and the time and sales and all of that, the volume, this and that. It's the only true and transparent information out there, and it has no lag. For example, you don't want to wait for a close of a bar, candlestick pattern, some Harami or three soldiers, or lightning cloud, or you don't want to wait for the actual pattern to set up before taking the trade. What that means for you and I as non-institutional traders is you can significantly reduce your risk in the markets if you don't have to wait for the actual setup to occur. So if you do wait for one of these setups to occur, a lot of times you're setting yourself in the hole with 10 ticks, 12 ticks, 15 ticks of risk. on each trade. And basically, when you can read the order flow and the transparency of the market, the language of the market, you can significantly reduce it by taking risk of 3 ticks, 4 ticks, 5 ticks. In markets even as erratic and crazy as crude or the Nasdaq or even something as liquid and as huge as the S&P. Because the time that it takes basically a lagging indicator or a bar to close, you can already be in that trade locking in profits and set yourself up for a runner or a potential runner. And now, I mean, really, isn't that all that we're all trying to do anyway? Is get ourselves into a situation where we have an opportunity to hit a home run. Other than that, it's base hit, base hit, base hit, base hit, base hit. So tonight, I'm going to teach you 3 things about decoding order flow volume that will, in my humble opinion, it's going to radically change the way you look at the markets. And towards the end, I'm going to discuss what type of markets should you actually be trading in and why. Because when it comes to order flow or the markets, normally most people think, well, going to order flow, most people think about order flow as, reading the bid and ask tape and the time and sales, and that's how it mainly has been done for many years until about 2006 when the HFTs and the algorithms really took over. There was something that we used to trade, well, it was called the New York Stock Exchange Order Book. And the high frequency trading in the algos pretty much made it obsolete. And many of those original SOs, bandits, and order flow traders are no longer around because you pretty much need to have a supercomputer for a brain to read the order book and just through watching the tape anymore. So of course, when most of the traders come to us, it's really, you can almost get lost in the numbers. And it seems like an avalanche of numbers. And if you look at it that way, it's no doubt it's a daunting task. But even worse, most retail traders get intimidated by complex numbers and math. And one of the funniest things that I come across all the time is the folks that try to prop up the market as it's this impossible animal to control. And I think what they're trying to do is they're trying to boost their own ego. And in the end, when you break it on down, it's all about this whole concept thing called auction market theory. And it's all about bringing the market's job is completely, its job is to be 100% transparent. But it's to be 100% transparent for the participants, for the participants that it serves. And the majority of those participants that it serves are commercial traders and institutions worldwide. So what we need to do then, in my opinion, is I think we should have an idea of what the institutions and the commercial traders look at, or what they do. Or at least, because they're large enough, they leave a footprint. They leave evidence, and they have an idea of what they're doing. They have instructions. And so all we really have to do then is follow them. We don't have to lead it. We don't have to anticipate it. We don't have to guess. We simply just wait and see what they're going to do. And then we follow along. I know I'm trying to, sound like that's all simple and everything, and I don't want you to get that impression. But that all being said, I can't teach you everything there is to know about order flow in the next 30 minutes. So if you want to get deeper into it, what you're going to learn here today, and start applying it to your trading, because you literally can start applying it tonight in tonight's markets or tomorrow morning. We're going to open up to the TradingPub attendees tomorrow morning, 8 a.m. Eastern Standard Time to 12:30 p.m. Click on this button here to register. I'll pop this into, I'll pop this link. See if I can pop this into the general chat. Or I'll pop it into the chat with Morgan, and maybe he can copy it and Send it on its way. Okay, so who's Global Trade Room? We've been doing this for, well, we've been involved with Simon, has been involved since about 2005, educating, and he's a numbers guy, he's a mathematician, physics major. He's the one that studied the tape for about 6 months and found these sequences and noticed these patterns that emerge. And he's a registered CTA, and it's very hard to find someone that's actually a registered advisor, trading advisor, who can actually advise. And what we're putting together is a very strong team. We are attracting, and you'll see testimonials from guys that have been, pit traders on the floor who have been trading since, 1987, or who are NASDAQ market makers, or were broker-dealer owners, or were working for large institutions. We are attracting the best of the best, but we're also attracting people that have been trading for like 6 months. So it's a great opportunity, it's a great community, and again, it's global, hence the name Global Trade Room. So let me go into this little presentation that I put together. And it's pretty much all about finding an edge and decoding order flow volume. Is the volume still coming in pretty good? Everybody still with me? I know it's late on your side. Good deal. So the first thing that you need, I think you need to understand about decoding order flow is, one, it's called hidden trade locations. Hidden. The second is an institutional bias. And the third is order flow sequencing. Okay? So through Global Trade Room and through the Ninja Order Flow Trader, we've developed a proprietary and tailored specifically to the teachings of order flow. So again, the three keys to decoding order flow is, one, hidden trade locations, two, institutional bias, and order flow sequencing. But before I really get into hidden trade locations, I really haven't told you much about myself. And the biggest question is, why should you even probably be listening to me? You have no idea who I am. I could just be anybody. But whether it's good or bad, I do have some market experience since 1994. And I want to give you a brief outline about my, I guess you could call it a unique experience. It's kind of led me to this level of understanding that few in these type of venues have. It'll also give you a little color about the 3 points that I'm going to talk to you about. So again, I've been involved in the market since about 1994, both from what they call the buy side, with a venture capital firm. I was an analyst, and so I was purely fundamentals, and I was actually in charge of identifying mergers and acquisition deals for the firm. Again, strictly by fundamentals. But I also spent time on what is called the sell side. Sell side at firms such as Swiss Bank. You can see that in the far right-hand corner. This is their trading floor. It's 2 football field long, 1,500 traders, and it's the largest trading floor in the world. And it's it's pretty amazing. Then you have Swiss Bank, where I traded for some of the largest hedge funds. I handled some of the largest hedge fund accounts in the world, actually. So just to give you a quick idea, my largest account, and this was back in 2002 through 2006. So these numbers may not be that big these days, but my largest account was called Pathway Capital, and it was a $35 billion private equity fund. And it would literally take me weeks to purchase or to sell a position because the size was so large. So they would buy into a company, a public company, and they would buy millions of shares, and they would get a huge discount. They'd get a Warren Buffett deal, and the deal would be that they couldn't sell it for 5 years, or 5 or 10 years or whatever. And then when they did sell it, there's obviously restrictions on selling it, and a lot of it is you don't really want to crush. You don't want to crush the market that you're selling. You kind of want to do 10% of the volume. And so by taking this understanding of you have large money moving in the markets, but they still have to play within these guidelines, so they don't disrupt or give their hand away. And in the end, it's all about reporting a good print back to your client, because you want to get more and more more and more business from them. But I would say most importantly, though, with the Bear Stearns experience, because I'm sure everybody has heard that it's no longer around. It's actually was absorbed by J.P. Morgan, by the backing of the U.S. government, and it was sold to them for about $2. But I got out of that firm it was 3 days after Christmas, December 28th in 2006, just in time to sell a lot of my shares, actually all of them. But not only did I call the top in Bear Stearns, but I also went to one of the largest high-frequency trading firms called SunGard Capital Markets, and I traded on their Ascent Capital desk. And what I did is I had the opportunity to not only short Bear Stearns all the way down to $2, but also everything else, Morgan Stanley, Fannie Mae, Freddie Mac, you name it. So I'm spending a little bit of time going through this because this experience led me to develop pretty much the first point that I want you to really take home. And you might want to grab a pen. You've probably already taken notes. There's been some great speakers. But again, it's called hidden trade locations. Sorry about that. Let me just get through this. And I call it the market matrix. One of my favorite movies. And I talk about this with the guys all the time. And it's looking at the characters, the grids, the numbers. And in the beginning, when you're first trying to look at the markets, it just looks like a bunch of numbers. But when you start to get involved and you start to understand, you start to see the blondes in the red dress. And what's important to pull out of all these characters and numbers and everything blinking and going across the screens is that, question is, why location is everything? So trade location. And also size matters. And then why price is not the main factor. So one of the problems I see with the majority of traders that I work with is that they just don't, let me go back to that, they just don't understand trade locations. It's really being able to identify where to take a trade based on the probability that an institution will defend that area or not. So what I can tell you is that hidden trade locations, they will show up as a massive trade volume imbalance, and a sequence will occur. The sequence will occur because a large institution cannot sell everything that they want to sell at one price. They have to sell it over time or over price. So, but the risk is that if you're not able to identify these trade locations, you're setting yourself up to trade against those who have the power to move the markets. You're basically trading against them, not with them. So it's very important to first identify or anticipate a trade location. And of course, that is shown through the order flow and the volume profile and the bid and ask orders. The second part is size. It does matter, and why? It's simply put, the market is controlled, as I mentioned before, by institutional order flow. And these days it's high frequency trading and algorithms. And in fact, it's probably larger than 60, maybe 65% of the daily volume on the New York. It's program related. But who do you think writes these programs? Who runs these programs? So in other words, we can kick and scream all we want about how unfair it is, but if you're trading against the institutions and those that the market movers, whether we like it or not, it's just a losing game. So the institutions and the commercial traders, they move the markets and they know where true value lies at all the time. So just recall briefly, I mentioned I traded for one of these large hedge funds. And it would literally take me weeks to sell a position or to accumulate a position. So we're talking about maybe 1 million shares. Let's just say, give or take 1 million shares. Think about it. If I'm selling, at the end of the day I had to sell 1 million shares, don't I have an idea of what value is for that market or for that stock? Because I have 1 million shares behind me. Yeah, I maybe let out 5,000, 10,000, 25,000 shares, but I've got so much more behind me. So I kind of have an idea of value, don't I? I know the value is going to be down, especially if I hit the bid. Of course, I don't want to do that because I'd end up reporting a bad print, but you get the drift. You have an idea of where value is. So these commercial traders, these guys that come in with paper onto the floor from Goldman, from this and that, they have large orders, and that's where the locals jump in and they start scalping, based around those papers. So size does matter. So if size matters and location is everything, and location is determined by the institutions who know the value, wouldn't it be a good idea to actually have an idea where they're doing business? You might at least have a fighting chance. But the third, and probably most retail traders, myself included, by the way, what we don't get about the hidden trade locations is that price. Price really is nothing, absolutely nothing more than an advertisement. It's an advertisement to buy something, or it's an advertisement to sell something. That's it. Without anybody agreeing to that price, which, if you agree to it, it's going to show up in volume or lack thereof, it doesn't mean anything. Let me give you a brief example. This is something I came up with. I could, this is hypothetical, right? We could go onto eBay right now and we can offer up maybe an original iPad or an iPhone, perfect condition. We could put a bid on there for 185 and an offer at 198. Now, how many are actually going to trade at that price? Maybe, let's just say maybe one, maybe two, because maybe someone's collecting it for some reason, a time capsule project. But just because someone, let's say they pay the 198, does that mean that we go long iPhones or original iPhones? I mean, absolutely not. Because, and guess what? We all have an idea of what the value is of an old iPhone. So we're not going to go ahead and buy it. But just because something, the price action ticks, upticks a tick or two, does that mean you go long? How many times have you bought the top just to see it turn around and flush you out? That's exactly what happens. So understanding or using price as an advertisement is really the easiest trick in the book for an institutional trader who's got 1 million shares behind him and actually knows what he needs to get done. For instance, if I had 100,000, a million shares or 100,000 shares to sell, and I float 1,000 shares or 10,000 shares to buy above the market, what happens? We call that top tick Tommy, and it's an actual guy who used to trade at Bear Stearns, and everything he did, he top ticked. He topped. If he was buying, we were selling. If he was selling, we were buying. And trust me, he owed the firm multiple six figures at a time. I don't know why they kept him around, but it's it's a who you know kind of deal at the firms. So in addition to being basically, I guess since 2006, HFT's algorithms have come to basically dominate the volume. It's basically their bread and butter. A firm's bread and butter is the high frequency trading, pairing the ones and the twosies, together and trying to create some liquidity to get something done. You can also see on a ladder, you can see if you have a real ladder that has got like 10 levels, not just 3 or 5, a dome, a depth of market, you can see them flash numbers well away from the current price, trying to get the market to do something, trying to advertise. I've got 300 to sell way up here. I'm interested. So it's basically, it's a game, and as long as you understand that price isn't everything, size matters, and location is everything, then hopefully you won't be trapped into top ticking an original iPhone for $198. So basically, it's bogus trades can happen. Icebergs. I'm sure you've heard all this lingo before. Everybody with me so far? Cool. Okay, so institutional bias. And I spent a lot of time thinking about this because let me tell you, I made some great trades in my life. Really, really great trades. And of course, the best trade in the world was getting out of Bear Stearns because everybody on the desk was, multi-millionaire, and they went down with, and 98% of them went down with the ship. For whatever reason, I saw the writing on the wall. Maybe it was my earlier training at the, doing the M&As and stuff. I can kind of, read a little bit. I can kind of, I can read a quarterly report. Let's put it that way, and I can read the actual fine print and understand it. But then I'm trying to come to you with this as honest and as forthright as I can, because when I left Bear Stearns and I did very well at the prop shop and all this, we were shorting for almost an entire year. And then if anybody was around and anybody can remember, they actually made shorting the bank stocks illegal. For I don't know, whatever reason, it was all around $30. Citigroup at $30, Morgan 30, everything was, I don't know what it was, a $30 threshold. And once it became illegal to short, yeah, there's no free market. Once it became illegal to short, of course, those things went down to $2, $4, $6, you name it, out of business, over and over and over. So obviously, I had to figure out something else to do, and so retail trading, and leaving the Bloombergs, leaving the direct access, leaving the capital, forget about trading. Other OPM is the easiest way to trade, by the way, and I learned a lot of what I know now through trading other people's money, basically losing other people's money, I should say. So the transition for me into this side of the business, you guys, was very difficult for me. And yeah, I mean, yeah, sure, you could. There were derivatives and there were things that you could do, but they made it very, very difficult, and it was literally illegal. So so I've spent a lot of time putting this together, and these thoughts are true, and it's really about an institutional bias, and that losses come first, and second, losses are more important than profits, and the third is retail traders. You and I, we take on way too much risk. Way too much. And as Paul Tudor Jones says here in his little quote, at the end of the day, it's the most important thing is how good are you at controlling risk. So really, again, the second thing you really need to know is about decoding order flow volume is the institutional bias. And when you're working on a desk at a fund or investment bank or what have you, the bias is all about risk, and losses come first. Because literally, if you continue to, I guess if your daddy doesn't know, if your daddy isn't somebody, and that's probably why Top Tick Tommy was around, but you continue to lose, on your trades, and you keep reporting bad prints to your clients and this and that. Your last meeting with the trade manager is there's going to be a little cardboard box, a little banker's box. There's going to be 2 security guards, and they're going to help you. They're going to escort you down the elevator. And that's what they have risk managers for. And it's all about how much risk is on the books, how much risk is on the firms across the asset classes, and it's why they have 2 football fields of traders, not just a couple guys. It's to spread the risk around, and because losses really do come first, especially if they're doing their business correctly. The second is you also understand it with institutional bias is that losses are more important than profits. And what I mean by this is it's not how much you can make on a trade. You can't go into every trade thinking, oh, I'm going to make $1,000 on this trade. It's all about the probabilities and how much risk the overall your overall book's going to have, or the overall book of the firm is going to have. And so what that really means for you and I is that with a strategy that you've tested and you've found high probabilities with, you've done your homework on, and you know that no matter what, there's going to be some losses. But more importantly, you know that to take those losses, take them quickly. Don't double down on them. Don't give them more room. Take the losses and then take the very next trade, because the odds of your success, because you have a high probability strategy that you've tested and you've traded, it's going to become that much greater. Does that make sense? And the last, retail traders, we get the guys coming in. Unfortunately, by the time they find us, it's a lot of times it's on their last account, and it's really, really sad. It doesn't have to be that way, but it's that game out there. It's that it's the threshold. The barriers to entry are ridiculously small. I mean, get involved. Get involved with $2,000. In trade, and quit your job. It's just ridiculous. But it's here and there. But my last point really is about having the institutional bias is that we take on, or before we really learn how to become profitable, we take on too much risk, period. So we all start trading, we think by, giving a little bit of trade to room to work out, it'll magically turn around, go in our favor, and it does sometimes. But if you think about it, that's absolutely wrong. Because the market is dynamic. It's not just the time frame that you're trading. It's not the 2-minute chart, the 15-minute chart, the 30-minute chart that you're trading. It's multiple time frames. There's guys coming in with bigger objectives, bigger money, bigger time frames. So it's basically, put it this way: if a trade goes against you, get out. And I'll put it into a real context. When I was working at the firm, the prop firm, we'd come in the morning and we would literally buy a ton of different stocks. We were New York traders, market makers. Buy a ton of them. Guess what? The ones that went up, we kept them. And we traded around them and we worked them. The ones that went down, we sold them. Absolutely sold them. Sell them quick and move on. And that way you don't blow up. So, and the idea then is to take minimal risk, get some profits in the book, and then look for the runner and ride that thing. Try to ride that thing till the wheels fall off. And you come up to bat every single time with that same objective. Hit a base run. Don't hit a home run. You'll get lucky and you'll hit that home run. One of our better traders called it vacation money. I come in, I swing, I hit, base hits all day long, every single day. And once in a while, I got a home run. I got vacation money. But I treat this as a business because I got to come in and day out, and I got to turn on the lights, I got to pay my mortgage, I got to keep the wife happy, keep the kid in school, that kind of thing, right? The last thing I want to talk about is what I call the order flow. I'm sorry, I'm just going through. This is an order flow tool that I tailored, and I'm not here to sell you anything. I just want to really just talk with you. The last thing is it's called the order flow sequence factor, and this is just a term I made it up. I made it up. But order flow is not just time and sales. It's not, well, I guess, let me see if I can, well, no, that just stopped the presentation. Sorry about that. I was going to pull in everyone knows what a dome looks like. Everyone knows what a tape looks like. And I'm sure everyone has, seen the tape run by, and you've even put in a filter on it. And you go, okay, if I see blocks of 50 come through, and they're buying, I'm going to buy with them. Unfortunately, it's not like that. And I'll tell you why. It's not just about the time and sales. It's not just about the filtering. It's about the sequence that they occur in, the pattern that they occur in. And that is what I talked about briefly, our head trader at Global Trade Room, Simon Joseph. But, I mean, just a freaking master, a master trader. But he's one of those guys that he could trade 10 markets at a time. It's just, he's just got one of those heads. And what he did, though, is he spent 6 months in a study, and he just studied the numbers and found these patterns and these sequences. And he would see that these things would return back to these patterns. No, it's not a black box. The guy's head is a black box. It's crazy. But no, it's not a black box. And I'll show you. I'll actually show you what I mean. But it's all about a sequence that it occurs in, and then it's not, and then the fine print. It's not about just a sequence that it occurs in. It's where that sequence occurs. You know what I mean? It's not just a sequence. If a sequence occurs in a tight range, are you going to have an edge? No, you got to find the edge. So I'll show you a little bit about that. But there are actually hidden messages in these order flows, and that if you can learn to uncover them correctly by correctly using filters, and it's not just by filtering out blocks and time and sales tape, but knowing that these filters mean something at the trade locations, you will be one up and you'll have an edge. Because the absolute one thing I really hate to see is smart traders. Remember, we are a breed. Each one of us, each and every single one of you guys and ladies are a very special breed. We are true capitalists. We believe that this can be done, that we can do it. And some of you are just too stupid to quit, which is good, because sometimes I think you have to be. But if you just keep you're pressing and pressing, you will figure out if you follow the things that I talked about. And really, again, you have to, just like Paul Tudor Jones says, you got to know. You got to know when to fold them, when to hold them, and you've got to know how much risk. Okay. So that's pretty much what I had as far as the discussion is concerned. I will show you some examples. But if you guys want to type in anything, or if you guys appreciate anything that they said, go ahead and you can mention it. Okay. Now, what I'm going to show you is, for some of you, again, remember I said it. For some of you, it's going to look like a bunch of numbers. Okay. And yes, it is. It really is a bunch of. You know what? What's the best way that I can do this? Let me bring in the S&P since it's trading right now. Okay. Hold on just a second, please. Okay. Now remember, this is all. I agree with you. It looks like a freaking mess. It looks like the Matrix. It's a bunch of numbers and it's a bunch of lines, right? I trust me, I was there. But just bear with me for a moment. So think of, okay, this is a 15-minute bar. These are actually candles. Candles, okay? A high and a low, a wick, green, red, close, open. What it registers is on the bids and the offers. And the bids are going to show, these are cumulative. And so at each price, there's going to be a number. And you can add them together and you do all kinds of things. But let me see if I can blow this up for you real quick. Okay, this is the S&P 500 on the 15-minute chart. If I can identify within this 15-minute bar, the highs and the lows, but can I also identify where the value is within this 15 minutes? And you can. You can take what's called a point of control, or a volume point of control, and it's this light blue line here. It's at 18.25. So what it's telling me is that within this 15-minute bar, the value is at 18.25. Okay. Now, if you also take a look, there are these blue lines that are coming out, and then there's some red lines that are coming out. What that's telling me is that these are institutions that were buying at this level at 18.25. There were three institutions, or three buys that occurred at 18.24.50, 18.24.75, and 18.25. Okay? And what happens then is this becomes a level indefinitely. And what you can do is you can take this information and move it forward and adjust. And the price reaction to these buys was obviously up. And at some point, it's going to continue to trade higher and higher and advertise for higher and higher prices until it gets so far away from value that the price is going to retrace back, or there's going to be an opportunity to retrace back. And so what happens is you're going to follow these markets up. You're going to look for a specific sequence. you're going to notice that there are going to be sellers and buyers. There's going to be some one-off lines. So there's going to be like a price here, one seller at 1826.75. No big deal. But then you have a couple sellers coming here, and that will become a level going forward that you can notate. So you can draw a line on this chart, and at 1828.50 is going to be a level that's going to mean something in the future. And we continue to go through that. And the opportunity is when you get far enough away from this meaning, you can short it back down to that area. If, by the way, there's two ways to trade. If you have the main trend is up, you probably don't want to, definitely in the beginning, you probably don't want to be shorting the tops, shorting the retracements. You probably want to wait for the retracements to come back in to have an opportunity to get long. And so this opportunity here at 1828, obviously it didn't show up, but the value shifted higher. So now we have, see these numbers here between 1832 and 1832.25? Notice how they're all blue right around here, all these buys. Buys, buys, buys. I can notate that information. And I'll say, okay, if we trade outside of this range, where's my edge? My edge is going to be, if we come back in within here, I have an opportunity to get long. So no opportunity yet, right? So what happened is the market itself, these buyers, initiated this move higher, and then the market accepted these higher prices. So once they accept these higher prices, you've got to say, okay, the market is accepting higher prices. I definitely don't want to short it. Value is shifting higher. So again, I still want to look for longs or an opportunity to get long. So my opportunity is not going to be within where all of this occurred. Where 15 half hour, basically a couple hours occurred of trading. My edge is going to lie outside, because within these areas, I like to call these like put a big X through it. Because within this X, remember trade location? Within this area, all the volume in here, those are where the large institutions are trading. Those are where the icebergs are happening. Those are where the algos are occurring. Those are where the HFTs are happening. And trust me, our little 1s and 2s and 3s and 5 lots are all they're going to do is just get swallowed up by the algorithms and spit out. And you're going to end up buying a tick up here and getting flushed back down, or vice versa. So you want to look for an edge. So the key is identify a trade location by using the numbers of value. The market is only searching for value. That's all that it's doing. And it's searching for value through price. It's going to advertise higher and lower to try to get buyers and sellers, more buyers and sellers together. I know I'm losing some of you, but is anybody out there with me? Okay. And like I said, you guys, as I said in the beginning, the fact that you're here, the fact that you're here is all that matters. If this starts to resonate with some of you, there are ways to study this information. I'm just trying to tell you that this information is transferable, and you can dumb it down after a while. You can. If I can find a value in a range, a tight range, and I could say, I'm not going to take a trade in there because I know I'm going to get eaten up by the algos, the HSTs, the iceberg orders, or the institutions, then that means I only have a choice. I don't do a trade, and I wait for something to happen outside of that area, right? So in a sense, it almost controls your emotion, your anxieties. You don't have to put a trade on every single moment. This is a proprietary ground up built. It's called the Ninja Order Flow Trader, and it encompasses a heck of a lot of information, but I don't really want to go through that right now. Again, you guys are all invited to come see us tomorrow morning. We also do free live trials every Tuesday. Trade live accounts right in front of you. You know, by all means. If Morgan, if you can plop in the, it's getting late for some of you. I appreciate that as well. And how boring is it to look at a melt up on a market? I mean, really, do I really have much to share with you? It was a melt up. It's one of the hardest markets to trade. One of the best things to do is just avoid it. You can't? Yeah, low volume melt up, uptick. So anyway, when you come out of value, you're looking for an opportunity for a retracement, and you can see and identify where these trades are going to occur based upon what the institutions are doing. So let me just do a real quick exercise. How much time do I have left? 23 minutes. Let me do an exercise for you. I'm going to go ahead and I'm going to do my homework tonight for tomorrow. Okay. So when you come in the morning, we're going to be putting on the trades on the Russell, and I'm going to thank you. I just saw it. One of the funniest things, well, no, it's not funny because I did it myself too, is when you first start trading, and I talked about this today, some of you guys remember who were in there with me. For whatever reason, the S&P 500 is so attractive, and everybody really thinks that they can trade the S&P. And I don't know why. Why is it? I can't figure that out. I don't know why. I don't have any. I'm sorry, I don't have any answer for you. But can I talk to you real quick about, are you trading the right markets? Remember I said, remember how I mentioned that we're all taking on too much risk? Perfect. Yes, proprietary. There's a lot of information. There's years and years and years of information. Please don't try to digest it right now. Just appreciate that it looks like a matrix. And that right now I could be the only one that sees the blonde and the red dress. Just like I said, there's just an opportunity. This is just a discussion. Please visit us tomorrow. The website's full of education on an education tab. You know what? I'm sorry. I don't want to lose all you guys too much, because I promise this is good information. Go to the Global Trade Room, and I know it's getting late. I appreciate it. Go to theglobaltraderoom.com. Click on the register. Okay. While you're there, go to the education section. I'm going to share with you some really good stuff. Free. Freaking free. Free's good. There's a couple things. Here's a little bit of information about how we trade. Addressing your emotional, download a trading plan template if you don't have it. But take a look at this. This is a very important white paper. It's called Exploratory Trading, and I typed up here, know your competition. Just do yourself a favor. Just read the thing. It's boring as heck, but you at least know who you're trading against. And this exploratory trading happens mainly in the S&P markets. The S&P markets are truly like the Super Bowl. That's where the best of the best trade. That's where the biggest of the best trade. That's where the best of the best trade from all over the world. And most importantly, what is the futures market there for? For stabilizing prices. It's so we don't have runaway inflation. And so governments use it. Huge institutions use it. So my idea to you is maybe take a look. If you are losing, if you are not consistent yet, or you're just break even, maybe take a look at the instruments that you're trading. Okay? And I'll tell you a quick example. I'm going to share with you something I learned a long time ago. And I went over this today, and that's why I'm going over it again. The S&P 500 is a breakdown on the right. The Russell 2000 is a breakdown on the left. Okay? The S&P 500, you probably can't see these numbers, and I'm sorry if I can't. Maybe I can blow it up. Here we go. Can everybody see that okay? The S&P 500 on the far right, Russell 2000. The difference is, take a look at the holdings of the S&P 500. Look at Apple, look at Exxon. 6% of that market is in two stocks. Too small, too fuzzy, still too small. Let me try again. How about that? So I have a question for you. Why do they call it 500 stocks? Okay, good. It's 500 stocks, but really what represents those 500 stocks is about 6. They're the 6 most largest, most liquid stocks. And remember I talked about advertising, this and that. The biggest institutions in the markets, they will advertise through the S&P 500, and they will play games in the Dow 30. I mean, come on, really? That's like 2 stocks. S&P 500 is like 6 stocks. It's ridiculous. But the biggest and the best and the brightest trade in the S&P. Now let's look at the Russell. So in other words, you can manipulate the S&P just by trading 6 stocks. The Russell 2000, on the other hand, this is the top weightings of 2,000 stocks. And you can see that not one of them have even a 0.5% weighting. So this is literally 2,000 stocks. So it's more difficult for an institution to manipulate the Russell 2000. They can manipulate the S&P 500. What does manipulation mean? Manipulation means they can take your money. They can take your 1s and 2s and 3 lots. Au contraire. Au contraire. All I'm trying to say is take a look at the S&P, understand that it's a very, very heavy market. And it's supposed to be very liquid, isn't it? Have you ever tried trading 3 contracts, 5 contracts, and then not getting a fill on the S&P 500? Like, please explain that to me. You're going to tell me you're going to take out 3, you're going to leave 2, you're going to leave me with, a not fill? It's just kind of ridiculous, right? So anyway, just consider that. And then lastly, look at, remember the markets are transparent, but they're transparent for the commercials and the institutions. So another market that you might want to consider is the Nadex market. And the Nadex market, there was a talk about that earlier today as well. It's a market, North American derivatives market, that was set up for retail traders. So what I'm going to do is, there's bull spreads, there's binaries. Chip, if you're in here and you can speak, I'll let you take the floor. But what I'm going to do, Simon Joseph is, if you go to globaltraderoom.com and you go under Contact Us, he's just the head trader. He's our head trader. He's our CTA. He's a licensed advisor, and he's a great trader. That's all. And he has helped traders who have been professionals before and had a difficult transition, such as myself. He's helped new traders, and it's not about using indicators or things of that nature. It's about using the actual market generated information. It's about using order flow. That's all. It's literally taking a mathematician and dumbing it down to these buys and sells, and then finding out where the trade, it's finding out trade location. It's understanding that pricing is just an advertising mechanism. It's not getting trapped. It's not trying to, again, it's pretty much the discussion that I went through, prior to this. So I want to take a look at the Russell market real quick and try to do our homework for it. And then I'm going to find a couple things to do using the Nadex product. And why am I suggesting the Nadex product? Because I just went through why the S&P 500 may, if you're break even, if you're not really getting the most out of your, out of your capital right now, trade in a market that's ready for you, that's built for you, that's actually transparent. Okay, what I mean by that is when you buy and sell you're an exchange member. You are buying and selling against another exchange member. There's no commissions, there's just an exchange fee. And it's just amazing. So I'm going to go through, this is the Russell, this is a chart of the Russell. Remember, it's just a bunch of numbers and lines to you guys. But I will be able to share with you some levels that you can watch. And you will see that the market will respect these levels. And all I'm saying is that I'm finding a trade location. When the market comes into that trade location is when there's a potential opportunity to do something. It's not based on pivots. It's literally based on institutional buys and sales. Okay? So, and guess what? You all can do this. And I'll share with you just right now. Everyone see these red lines that are coming out at the 50s, 55, 56? See how they're blocked? Like they're stacked? A couple of them, see them? Threes, twos? That tells you there's someone large in there, and they're trying to get the market down, but the market didn't go down. So guess what that becomes? Sellers become oops, they're all yellow now. Now it looks like a mess to all of you guys. Let me just take this for you, and just jot down 1157 and 1155. Yes, this becomes support. So guess what? We are in an uptrend, aren't we? We are risk on. Risk on means they're jamming for high beta and alpha. That means the Nasdaq's going higher and the Russell's going higher, therefore the S&P is going higher as well. But if we get a little bit of a sell-off in the morning, the level you want to be looking at are going to be these levels. So let's write down, let's use the Russell, humor me with the Russell, 1157 through 1155. You're going to be looking for an opportunity there. Next level up. You see these stacked orders in here? That is going to be our next trade location. 1159, 1158.9, basically a point. And that's us. Okay, perfect. So this is where we currently are. So don't top tick Tommy up here. Don't buy this at the open. You have this first level, 1159, and you have this second level. Now, of course, there's more that goes into it. There's an actual pattern. There's a sequence that occurs, and you can actually read as these numbers are coming in. As these numbers are coming into this 1159 on the bids, you're going to watch to see those getting less and less aggressive. Absolutely. Those will be my opportunities to get long. 1159 and down here at 1156. There you go. There's a whole lot more information in here. I don't want to go through it right now. It's not that important, but let's take a look now at just a quick little market in the Nadex. And I just want to just log in here. Darn it. What is my password again? Darn it. There we go. Okay, it's coming. All right. Here we go. Okay, let's take a look. The indices. Remember, I'm sharing this with you because I think, again, I'm just talking to the folks that are still break even, that you may be trading in the S&Ps, that you may want to take a look at something else. Remember, I think you're taking too much risk. Is everybody with me on that? And I will hallelujah the day that comes. This has been anyway. I like let's put it this way. I like two-sided markets. Okay, where are those levels again? Those levels are 1159 and 1155 on the Russell. So I'm going to go into, and I know someone went through, what Nadex is, and so I'm not going to go through that again because I think it was just about an hour and a half ago, maybe 2 hours ago. But let's look for those levels. Those levels of 1159. I'm going to look for two things. Tomorrow, U.S. Small Cap 2000 close at 415. I have 1130 to 1160. That's a range, right? And then I have a range of 1135 to 1185. Then I have a range of 1145 to 1175, and then I have 1160 to 1190. So I'm going to choose 1145 to 1175. Okay? Now, if I were to go in right now, for every contract, I'd be risking $171 to make 129. Not good, right? So, but what I'm doing is I'm going to set up a situation to where as we come in, using those levels, now I'm going to buy a spread that is basically going to give me 1145 to 1175. All the way up to 1175. Okay, that's the range. Now, I have levels down here and I have levels down here. Now, if we get down to 1156, I will be buying that long to 1175. And I'll have to the end of the afternoon, and the risk is most likely going to be cut in half on that max loss, and I'll have a max profit. But what it does is, let's say the crash of 1929 happens tomorrow. I have a floor of 1145, so that means I can't get hurt. I already know what I'm going to lose. If I bought it right now, I know I would lose 171 per contract. But I would lose no more than that if it went that much further. Let's take a look at this one too. Let's say we don't come all the way back down in there. Well, let's say we have 160 to we have 1160 1160, a floor, and a ceiling of 1190. So let's set up two situations. Let me put, I only have 4 minutes left. Okay. Now, if we come in a tad, or if we trade, let's put it this way. If we trade higher and then we come back in, then I'll be looking to buy this one here, the 1160 to 1190. And then what that would mean is my maximum loss is 53, but I could potentially win 247 if and only if it went to 1190. So I have two opportunities. One is if we go straight up and then we come in, or if we come in and then we head higher. So I have two trades. Lastly, and by the way, if I did, let's say I did 171, that is exactly the amount of money I'd have to put up. $171. Now, of course, that's lopsided, and you know, I truly believe I'm going to get 59 or 56. And if I don't get it, I don't take the trade because that's not the trade location. And then lastly, tomorrow, when this opens, we can do, let's take a look at it now. Maybe we have 2 minutes left. Okay, I'm not buying 1160. I'm not top ticking. But let's see, let's take a look at 1159, 1156. I want, let's take a look at this 1155. Okay? Right now, this is telling me there's about an 80%, 75-80% probability that the S&P, that the Russell is going to close above 1155 by 4:15 tomorrow. So if I can get this closer to 50, I'll have a 50-50 chance. So I don't want to buy that at this price. This is based on the underlying price of 1162 where we're at right now. But again, I know about trade location. I know that these previous areas here, sellers, are going to be support. So I'm going to wait for the market to come into these levels, and then I'll take the opportunity. And then I have the whole entire day for that to work out for me. So again, just something to consider. If I did put on a trade right now, I would lose $80 to make 19. And I don't have to do that right now. So I'd much rather get a better price and a better opportunity. Yes, I know. Anyhow, there is spread. There's spread in here. So the thing is, as soon as you put in an order, you're a market maker. So I can put in a difference. I can split the difference if I want. There's a risk that I don't get filled, but who cares? If I know I have a trade location and it's coming in, I'm going to put something in below the bid. And I'm going to wait for that thing to come into me because, again, trade location. The NIBOT. And the ICE. Everything trades on the ICE, yeah. But this is its own, the Nadex is its own exchange. And these will bring buyers and sellers together just like everybody else. Except this one's not dominated by HFTs, algorithms, and icebergs. And guys that'll eat your lunch in a heartbeat. So, again, appreciate the opportunity to speak with you. 15 seconds left here. I like the discussion coming through. Again, all I can offer you is my experience. I've had some great trades in my life. You know, like I said, some of the best trades in the world for me were getting out Bear Stearns. One of the most difficult things for me was also the transition. And I found a guy, it was important for me because he was registered, licensed to advise. Yeah, he's more expensive, but hey, I really wanted to learn how to trade as a retail trader. I literally got to the point where I had to either I had to figure this out, or I had to go back onto a desk. Anyway, thank you very much, everybody. I appreciate it very much.